All right, okay. So, it's going to be a hard act to follow. But let me have so let's do this. Now, you know what we mentioned is, this of course is cost, right? This is an estimation. This is an estimation. So what do you do if part of the way through the year, after you get some experience with this, is you say, I think this is going to be different. Maybe we can get more out of it. Yeah.
You change it.
Exactly. You do change it. I'm sorry, change what?
You change the estimate.
You do change the estimate, sure, all right.
You said, what do you do? So I said, you change
Oh, I
it.
see, okay, that was like a rhetorical, okay, good. Yeah, I thought it was like a rhetorical question.
Oh, well, that's what you do,
So,
you change
yeah,
it.
just like, you ask somebody how they are and they stop and tell you.
Yeah.
You know,
Yeah.
yeah, I'm good, I'm
Hey, I
good,
like
I'm
to
with this,
talk.
I just was saying hi.
I like to talk, you don't ask me questions, you don't
Okay, well, all
I will
right,
tell
well,
you how I
listen,
am.
and to kind of use that as a segue, you change it, okay? Here's the deal, now what you do is you get the remaining, what you do now. So in this case, when they made the new estimations, right? What they do, so in this case, what they have is now they have so it cost 10,000. At this point in time, there was 3,600 in accumulated depreciation, so this is the cost. This is the accumulated, and I'm just going to write accumulated, but it's accumulated depreciation. Okay. Therefore, that difference is 6,400, and that's the book value. Okay. So now, what you do is, so this would be the revised, this would be the change in estimates. Okay, the change in estimates. It's the book value minus the revised salvage value divided by the revised remaining useful life. So, at this point in time, there's 6,400 left. That's the book value. They estimate that instead of getting $1,000, they're only going to get 400. And at this point in time, they estimate they have 4 years left. So now what the deal is, now the depreciation on the straight line rate will be 1,500. So, like you said, what they do is they take the book value, they put in if this changes, they put in the revised salvage value. If this changes, they put in the revised number of years left. Okay? All right. And so now it's 1,500. So they are estimates, and as life goes on, you can revise them because it's a little more obvious than what will happen. Okay? All right. So let's do this. Why don't we do quick study 10-5. You find that on page 421. And by the way, I do appreciate your input. You were right on the money. You just put in the new numbers. Thank you. Yeah.
One question, so when you came up with 400, where did you get that number from?
Yeah.
That's the revised. What it is as it's gone on, they said, now, when we first bought it, we estimated that we'd be able to sell it for $1,000. Now, 2 years later, things look different. 2 years later, we say, instead of having 3 years left, we're really going to have 4 years left. And when this useful life is done, instead of selling it for $1,000, we're only able to get 400 out of it.
So you're given that information in the equation?
It would have to be, in this case, for us, it would have to be a given.
Okay.
However, and where it comes from is on the job. It just be, as things move on, it's more clear how things are going to work out. Maybe they have a later model, and so your model is going to be pretty worthless. Maybe you had good maintenance, so there'll be a total of 6 years instead of a total of 5. But at these are just revised estimates. And again, it's going, and even with this revised estimates, chances are it'll be off. So, let's go ahead and take a look at quick study 10-5 on page 421. So I'm going to turn the camera, and I hope this proves to be a worthwhile venture. We'll have to see. I'm going to move it up. All right. So let's go ahead and read that. So here we have 10, quick study 10-5. And that's on page 421. And here's how it reads. So, refer to quick study 10-3, and that's this one up here. I'm going to make it larger. Now let me turn up this light so it's easier to read. So, and by the way, you guys be sure to always bring your books because it's so much easier to work with. Okay. So here's the data that we're working with. So we're doing 10-5, but we're working, so the data in 10-3, what it says is, what it says is, on January 2nd, 2011, the crossover band uses store equipment for the concert performance at a cost of $55,900. So that's what they paid for it. They estimate they'll use it for 4 years, and they anticipate about 120 concerts. After 4 years, they're going to sell the equipment. The salvage value will be $1,900. Okay. Now, they used the straight line depreciation, but realized at the start of the second year that due to concert bookings beyond expectation, this equipment only lasts a total of 3 years. The salvage value remains unchanged. Compute the revised depreciation method. So you need to figure the book value, and then figure the revised depreciation. I wonder why this thing isn't more clear than it was this morning. Huh.
That's your law.
Yeah.
Is it 3 years beginning from last year or the current year?
Well, let's see, what it'll do is, so last year, it was worth, they estimated 4 years.
Right.
So now, and they should, so at the end of this year, right? At the start of the second year, so if they started with 4, 1 is gone, 3 should be left.
So then he has 2
But-
more years left?
Now there'll only be 2 left because there'll be a total of 3. So now there's only 2 left.
Basically, you have to subtract the first year's depreciation before you figure out the second.
That's exactly right. So figure, if that heads right in the money, figure the first year's depreciation subtracted from the cost to get the new book value.
Subtract that. And then that's your book value. That's your book value. And you do the second year. 55, 35 is your book value, starting at 18. And then you subtract your 19 salary value. Yeah, 19.
Well,
Yes.
should we do 10-3 and then from there do?
Well, here, let me show you. So what it is here's the cost. And here's the first year depreciation,
How'd you
right?
get that?
What it is, it's the first year depreciation. So to figure that, what it is it's, well, actually, I think I can show you right here. And just by way of explanation, so cost minus salvage value is depreciable cost divided by the number of years comes out to 13,500 every year. So Jean, can I check with you? Was this giving you the answer that you wanted?
Yeah, I was just wondering if we did 10-3 before we did 10-5.
Yeah, yeah, I see what you're saying. Yeah, you gotta do 10-3. So now what it is you take the cost minus the 13,500 and that gives you the book value at the beginning of the second year. Then, here's the salvage value, the remaining depreciable cost, 2 years left, depreciation for years 2 and 3.
At the end of year 3, it'd be down to 1,900, which is the salvage value.
It should be, yeah.
So it said, what it meant was it's only gonna last 3 years total, and it's already been used for a
Yes.
year. So that's how you get the 2 years life remaining.
Exactly. And original, so exactly. Mm-hmm. Right on the money.
I guess that margarita was such a good idea last time, huh?
Well, well, listen, let's do this. Let's do exercise 11. And it's the same thing on page 423. Okay, so let's do exercise 11. On page 423. So now, what happens if I put this on the other screen? Is that
Can you put it back?
What's that? Put it up? Sure.
Almost done.
Sure, thanks. Here's the answer, and can I see if there's any questions in that before we move on?
Wait, why are you subtracting the salvage value again when it was already done in the first calculation?
Because you have to recalculate it every time.
Yeah,
But was it?
let me refer you back to this example. What you're doing here now is the first, of the top part of that, where you come up to 4,200, that is how you figure the book value, right?
Mhm.
Now you take the book value minus, in this case, it'll be the salvage value, it's not revised,
Okay,
and then divided by the revised useful life.
okay.
So in answer to your question, it's the revised, it's the new book value minus the salvage value for the remaining depreciable costs. That's how much depreciable cost is left after the first year.
Okay.
Now, I'm going to move this over here, and let's see if this, so here's exercise 1011, it's this one right here. Let me put it up here. See if that's easier to read than the other one is. Okay, so what it says is Supreme Fitness uses straight line depreciation for a machine costing $21,750 with an estimated 4-year life and 2,250 salvage value. At the beginning of the third year, Supreme determines that the machine has 3 more years remaining useful life, after which is estimated to have an $1,800 salvage value. Compute the book value at the end of the second year and the amount of depreciation for each of the final 3 years, given the revised estimates. Anybody looking at this?
Is that 3 more years total, or 3 years in addition to the 2 years it had left?
Let's see, let's take a look here. At the beginning of the third year,
So
it
there's,
has 3 years, so it's
So
3
it's just
years
3 more
left
years
at the end, so the total is 6 under the revision.
Because at the beginning of the third year, would it be total
Well, let's see, at the
No,
beginning of the
7
third
years.
year, so there were 2
so
then,
there
that's
were 2
right.
left, so do we add 3 onto that, or is it just
Total of
extend it up to?
It's a total of 5.
So,
Total of
It is a total of 5, right?
okay, so,
But,
but we're
but,
calculating for 3 more.
exactly, so what you do is you find the book value at this point in time, right? Subtract the revised salvage value, that'll give you the new depreciable cost, and divide that by the years that are left, starting at that point in time.
Steve, did I miss that? So if we have 4 years estimated, at the beginning of the third year, it determines that there's 3 additional years remaining. It
Mm-hmm.
would be 4 minus the 2 that are down, plus the 3, wouldn't that be 5?
Here, I'll show you.
you added 3 to the
I
year,
guess it's not 3 additional years, it's just
3 years left.
3 years
So
estimated remaining.
3 years remaining.
The 2 that you haven't used yet, plus 1.
Mhm.
Yeah.
So what you do is you first of all figure the original cost was $21,750. Okay? Now, 2 years have gone by. So the depreciation for those 2 years is the cost minus the cost minus the original salvage value divided by the original estimation of its useful life. That'll give you each year's depreciation on the straight line. Since there's 2 years, you multiply it times 2. So this is the total accumulated depreciation after 2 years. That's the book value after 2 years. Does that make sense?
Okay.
Now,
Can you give me like
what's
2
that?
more minutes?
Sure, I'd be glad to. And give a yell, okay?
Okay.
All right, now, you take this book value, plug that into the formula, okay? And then, so here's the book value, here's the revised salvage value. So this is the new depreciable cost. Divide that by the remaining years, and this is the cost per year. So this is the depreciation expense per year. See if this is helpful. You take the book value at this point in time. You subtract the revised. Let me just put this. So you take the book value, subtract the revised salvage value, and you divide that by the remaining years.
Which is 3, right?
Exactly.
Okay.
And all I'm doing is I'm taking this data, just putting it in a different format. So in this case, the book value is 12,000. Okay? The revised salvage value is 1,800, and there's 3 years left. So every year, it'll be 3,400. So all this down here does is take the same data, just put it in a different format, okay? So, and by the way, I'm going to move it over to the other overhead, just because that overhead is more clear. So let me put this here, put this here, let me zoom out, and this one is more clear. So again, I just took that same data but put it in a different format. So what the numerator does is it gives you the new depreciable cost. You have the remaining years. That will give you the amount per year. And so this does the same thing as that, different format. Okay, puts it in formula form. Sound good? All right. Now, you guys are okay with that? How you doing? Good. All right, you guys doing good? All right. Well, let's go on to a new topic then. I'll turn on the lights. And the new topic is, now, what we're going to do is the asset has reached the end of its useful life. Okay, and so what we're gonna do is we're going to, first of all, there is a topic in here that comes up first. Okay, all right, let's go back. So let's come back to that, because I think we can do a better job of that, the math there. So what happens here is the fact that the end of the useful life has arrived. And so what you gotta do is you've got to dispose of it. And there's three things you can do. You can discard it, you can sell it, or you can trade it in, right? Now, what happens on this, the trade-in, we won't deal with in this class, it'll come up in future classes. It's just kind of detailed, it's not terribly difficult, it's just detailed, okay? So let's deal with the discarding and the selling. And what happens here is when you discard it, the book value is a loss, okay? If you sell it, the amount of cash you get compared to the book value will result in either a gain or loss. So if you receive more cash than the book value, it's a gain. If you receive less cash than the book value, it's a loss, okay? So let's start with discarding. So if you discard it, now in this particular example, the machine cost $9,000, that's the cost.
We're
Okay.
discarding first?
I'm sorry, what's that?
We're discarding first?
And we'll start with discarding, okay? And so this is what you discard. And again, all we're going to do here is we're going to, the amount of the book value will show up as a loss. So in this case, and the accumulated depreciation is 9,000. The book value is 0. So if you discarded this, how much of a gain or a loss would there be?
No.
None. Okay? So what you do is, when you get rid of an asset, you remove everything from the books. So in this case, let's say you did this on June 5th, what you would do is you would debit accumulated depreciation. I'm going to abbreviate here, ACCUMDEP. You're going to debit it for the 9,000, and you're going to credit machinery for 9,000, and there's no gain or loss, okay? And you're removing both of these accounts from the books. Yeah, Addie?
And that includes the salvage value, the 9,000 accumulated depreciation?
Well, actually, the salvage value doesn't come into play here. What this says is that the salvage value is 0,
Yeah.
is what it's saying. So, what they're saying is that the book value is 0. And so what you did is you paid $9,000 for it, you got $900,000 worth of depreciation expense, you threw it away. And so, I hope I'm giving you a good answer here. So the salvage value doesn't come into play here. The salvage value would be 0, okay? And all you do in this case is remove everything from the books because it's gone
The
by.
salvage value would have had to be 0 though from like the start.
Yeah,
Otherwise,
in
we would
other,
bring out the
sure,
original
in
book
order
value.
to get down to a book value of 0, the salvage value had to be 0. And the reason is, you don't depreciate beyond the salvage value just because you'd be claiming more depreciation than you would reasonably expect, and there'd be no point in that, unless you revised it. Okay,
And you said you would debit both accumulated depreciation and machinery?
no, accumulated depreciation has a credit balance, so what you do is you remove it from the books with a debit. An asset has a debit balance, so you credit it to remove it, okay? All right, now, what happens on this thing is now, let's just save space. So now what happens is it costs 8,000, okay? And
Are we doing sell
this is
now?
a debit problem, right? I'm sorry, was that you?
Are we still on discharge or are we doing sell?
Listen, by the way, could you, if you raise your hand, you'll sure help me out, because I keep getting caught,
Sorry.
no problem. Hey, listen, thank you. Now, yes, and what's your name?
Tiffany.
Tiffany. Tiffany.
YouTube, you'll hear me a lot.
All right, okay, all right, Tiffany, what do you got?
Sorry, are we doing this cardigan or are we doing cell now?
We're doing discard,
Still?
different problem.
Okay.
Okay, all right, so discard is different problem. Okay, all right. So listen, now the accumulated depreciation, I'm going to abbreviate here, right? Is 6,000, okay? Now, the first thing you do is what you do is you bring the accumulated depreciation up to date. So in this case, it's $8,000 minus no salvage value divided by 8 years, so the annual depreciation is $1,000. In this case, this is discarded in July, okay? So that means you're going to have half a year of depreciation. So the depreciation from January 1st through the date of discard is $500. So the first thing you do is you bring depreciation expense, this is July 1st, you bring depreciation expense up to date. So you debit depreciation expense and you credit accumulated depreciation for 500. Okay, that's step one. Then step two is you remove everything from the book. So in this case, on July 1st, what you have is accumulated depreciation was 6,000, so now it's 6,500. And I'm abbreviating here. And you're going to remove that from the books. And the equipment, which will be here, is 8,000. What that means is there's a 1,500 debit. If it's a debit, it'll be loss on disposal of equipment. And I'm going to abbreviate EQ for equipment. So one way of doing this is to, so in this case, you could have found the book value, 6,500, this increased by 500 from 8,000, the book value would have been 800, would have been 1,500, and you could have written that off. Or you could treat it as a plug figure. Had the plug figure been a credit, it would be a gain. Now, Tiffany, can I check with you? You doing good on this? And I hope I'm not putting you on the spot if it was meant to.
No, I have the deer in my headlights still.
Yeah,
I
okay.
mean, I kind of understand, but I can't really see down there, that's why I was like, okay, because like,
Oh, so you gotta move your, okay, maybe, yeah, what,
if you could just read me the last 3 lines, that'll be good.
the last two lines say loss and disposal of asset, debit 1,500.
Okay.
Would it be helpful if you stood up?
I
Okay, just trying to be helpful here,
Okay.
all right? And then you're going to credit equipment for the 8,000.
okay.
So what this is doing now is it's removing everything from the books by debiting the accumulated depreciation and crediting the asset, and then you have a plug figure. It's a $1,500 debit, that means it's a loss. If it's a $1,500 credit, it would have been a gain.
Okay.
But that's the equivalent of a plug figure that makes the debits equal to credits.
Okay.
Now, to make sure you're getting a good answer here, what you can also do is just find the book value, and that is the loss. So in this case, it went from 6,000 to 6,500 when I have that additional depreciation, right? That means there's a $1,500 book value, and that $1,500 is how much of a loss you incur. It's the book value. Is it just another way of saying the same thing? Does that sound good? Yeah.
How come the debits don't include the credits as well?
They do. Maybe, again, I was just, yeah. So again, now you got, Debbie, you got $8,000 worth of debits and $8,000 worth of credits. But is that what you're referring to?
So the first one is 6,500.
Was this 6,500? Okay. Okay. And yeah, the debits would always have to equal the credits. Take that as a given. All right.
Another question, Lee.
Yeah.
So on July 1st, you credit accumulated depreciation and then you debit it. You do both those on July 1st.
Yeah. But hey, listen, let me give you a good answer here. So now don't forget, step one is you bring the depreciation expense current. Step two is you remove the asset from the books, is the step. And of course, what it does is it makes your income statement accurate, because now, this will show up as depreciation expense. This shows up on a loss and disposal of equipment. Okay, and they're both, I'll be right with you, Tiffany, they're both just more accurate. Now, a change as of maybe 2 years ago, this loss and disposal of as equipment would have showed up under other income at the bottom of the income statement, and this would have showed up as an operational expense. That's one reason why they do it this way. A recent change makes this loss and disposal of a depreciation expense, so now the net of the effect is less. However, it's still more accurate if you do it this way, but this is reported as an operational issue. Tiffany?
This might be a silly question, but what do you mean by the term plug number?
Whatever it takes to, so the debits equal the credits, like was mentioned here. So in this, so in this case, a $1,500 debit makes the debits equal the credits. A
Yeah.
plug figure, and then if it's a debit, it'll be a loss and disposal of
Yeah.
assets.
I understand.
And had the plug figure been a credit, would have been a gain.
Yes.
And by the way, that plug figure will save you all kinds of work later on in the course, because it's really a short, it's really a simple way to figure things that you would have had to,
Yeah.
okay, yeah.
And so, in this scenario, are we showing both of them, like at July 1st, depreciation expense, accumulated depreciation? Are we doing either or depending on whether we
Do
use?
both of them.
You have to show both.
Do both of them.
Okay. You couldn't just cut to the chase and do the 8,000 costs and do the accumulated depreciation.
No, and the reason is, I'll be right with you, the reason you're doing it now is the fact that depreciation expense needs to be accurate, and, yeah.
You're just accounting for whatever the loss would
Yeah,
have been, even though it's
exactly.
obvious.
Well, it's not obvious, but when you go to your income statement, your depreciation expense will be accurate, and because it includes this $500. And then, down here is when you remove it. Okay. See, what it would have done is it would have overstated your loss had you not done step one. And it just would have been inaccurate to that extent. I'll be right with you. Does that make sense? Yeah, yes.
What's the part that I'm confused about is the equation, like the 8,000 minus 0/8. Like, how are we just supposed to pull that out and know that?
Well, they actually, that has to be a given.
Okay.
And what they tell you is the cost was 8,000. There'll be no residual, no salvage value at the
Okay,
end
that's
of
why
its
there's
useful
a zero,
life,
it's just because there's no.
divided by 8, and that has to be a given.
Okay.
And of course, it just means that there's no, at the end of its useful life, we're tossing this thing. And it's got to be a given. Yeah.
Oh, I was just gonna say, if you don't do that first step with the 500,
Mhm.
then under accumulated depreciation at the bottom, it would say 6,000, and then you would have a different amount, so it wouldn't figure in for that part. So that's why
Exactly.
it's important.
If you didn't do it, then on your income statement, if you go to depreciation expense, it would be understated by 500, and your loss would be overstated by 500. And again, 2 years ago, that would have made a big difference between, maybe 3 time flies, who knows, maybe 4. Anyway, in the very recent past, the loss and disposal of assets was reported down with other income, down the bottom, and this would have been operational. Now, because this is reported with operations, it doesn't really make much difference, but it would have in those days. I think there was somebody who's ahead of it. Anybody who was ahead of this? Oh, thank you, I thought somebody had a hand
I
up.
think I missed, why is the 1,000 multiplied by half to equal 500?
Oh,
I missed
because
that
it's
step.
July.
Oh, okay, so it's halfway through the year.
Yeah, depreciation is normally an adjusting entry. And so if the fiscal year ends December 31st, it doesn't have to, but they said, but it does. So as of December 31st, all of the depreciation had been calculated. Now, 6 months later, they dispose of this thing, and so 6 months later, there's more depreciation. Okay, yeah.
So did 6.5 years go by here then? Okay. The 6,500 was.
Yeah, it would have been 60, exactly. And by the way, it was, I changed this to 6,500 because it was after we figured the depreciation, but 6 years had gone by,
Yeah.
and now 6.5.
Okay.
Yeah, that makes sense.
Okay. All right, good. Any other questions? All right. Okay, so let's do this. Now, let's go over what happens if they sell it. And again, what you do is you figure the book value, and the amount above or below the book value will be a loss or a gain. Okay, I'm going to go out this way, it'll be shorter. So in this example, okay, what we have here is, so the cost was, they have 16,000 cost, okay? They have 12,000 accumulated depreciation. That meant the book value was 4,000. Okay? Now, what we have here then is, in this case, the accumulated depreciation and the annual depreciation is $4,000. Okay? So, by coincidence, they're the same number. That's the annual depreciation in this particular example. Okay, and what they do is they're discarding it March 31st. So January, February, March. So 3 months after the end of the fiscal year, they're discarding it. So 4,000 times 3/12 comes out to be $1,000, be 1/4, sure. So step 1 is you bring the depreciation current. So on March 31st, depreciation expense will be debited for $1,000, and accumulated depreciation, I'm just abbreviating here, will be credited for $1,000. Now, this is still 16,000. This is now up to 13,000. So the book value is now 3,000. Does that make sense? So this is as of March 31st. Okay, does that sound good? And this is December 31st. Is everybody okay with that? Mariah, I see kind of a quizzical look. Does that make sense?
Sure. Keep going.
Now, you're just not a kind person right now.
I'll figure it out.
All right, here's the deal. And December 31st, so this is 2000 x 2, 2000 x 1, December 31. So the end of last fiscal year. Here was the cost, here was the cumulative depreciation, here's the book value, right? 3 months later, there's another $1,000 of accumulated depreciation, right? Okay, so now the depreciation expense the accumulated depreciation has increased by 1,000, and the book value went down by 1,000. Okay, now here's the deal. What happens on this thing is, if they receive 3,000 in cash, no gain or loss, because it equals the book value. If they receive $4,000 in cash, what happens? A gain. If they receive $1,000 in cash, a loss. Okay, now in this case, they got the $3,000. So when they get the $3,000 on March 31st, you're going to remove everything from the books, and you're going to have no gain or loss. So in this case, cash is debited for $3,000. Okay. Accumulated depreciation will be removed from the books by debiting it for $13,000. Machinery or equipment is the name of the asset account, and I'll write EQ just to move along here, will be credited for the $16,000. And there's no gain or loss. There's no plug figure because the debits equal the credits. Does that sound good? Now, what does it look like if they receive $2,500 in cash? Okay. Now, if they receive $2,500 in cash, what will happen is there'll be a $500 loss. Does that sound about right? Okay. Scott, is this getting a little hard to read over there at that distance?
No, I just got a tripod in the way.
Oh, got a tripod in the way, all right. Mariah?
What does the EQ stand for again?
Equipment, and just, it's an asset, the name of the asset account. And listen, and by the way, I just abbreviated to move along, but it's no benefit, it doesn't make any sense. All right, no, I just was going to, yeah, okay. Now, when they receive the 2,500, and I think this may be the fastest way of doing this, now what happens in this is, everything is the same down to here. Is that okay with that? But what happens is the cash will now be a debit of 2,500. I'm going to leave a blank space here. The accumulated depreciation, and I'm abbreviating here, will be debited for 13,000. And here's where I'm getting that number. The equipment, I'm sorry, it should have been a debit. Equipment, and the EQ will work this time, should be 16,000. Now, because they received $500 less than the book value, you're going to have a $500 debit. Now you can treat it as a plug figure, or you can just see that it's less, and that will be a loss on disposal of the equipment. Okay? So because the plug figure is a debit, it'll be a loss. Or another way of saying the exact same thing is because it's $500 less than the book value, it's a loss. That sound good? Okay. All right, so let's do this. Why don't we start by doing quick study. 10-9. Okay. Let's see, now we're out of here at 2:20, right?
320.
3:20. What a relief. All right. All right, so I'm going to turn that to the front. Turn this to the front. Okay. And let me turn on the lights so this is easier to read. And let's go over this. Okay. So, exercise 10-9, no, quick study 10-9. So quick study 10-9, and here's how it reads. And I'll put it over here on this one because this is easier to read, it's smaller. Okay. So what it says is, the Horizon Company, owns equipment that costs $138,750 with accumulated depreciation of $81,000. Orion sells the equipment for cash, recording the equipment assuming that they sell it for $63,000 cash, $57,750 cash, $46,500 cash. Okay? Well, then it'll be a credit, and it'll be a gain in disposal of assets. Yeah, then it's a gain in disposal of assets.
And it goes to credit
And it'll be a credit
instead of a debit.
instead of a debit. If it's ever a credit, it'll be a gain instead of a debit. They work the same as revenue and expenses. exactly, everything happens on the 31st. So, and when that happens, everything, everything is the same down to the third line except. Yeah, but get the third. You got it. So, in this case, the book value of the old machine is the cost minus the accumulated depreciation, so it's $57,750. I'm going to turn this thing back off and put it back on, because sometimes if you just reset it, it's acting up. There we go. Fix it. And before we go any further, let me see if anybody has any questions on how they're working this. So you took the cost minus the accumulated depreciation, find the book value, $57,750. And then the cash was greater than that. This is the cash. So when the cash is greater than this, that'll be a gain on the sale of assets by that amount. And so you're recording the receipt of cash, you're removing the accumulated depreciation and the asset from the books. There's the plug figure, if you want to work it that way, you can work it either way. $55,250. Yeah.
I just have a question. Since we're making money, do we not have to do the depreciation expense and cumulative depreciation?
That's presumably been done.
Okay, so that's.
So, exactly. So it's simply been done for you. But you know, that's a really good question, and that's something you got to ask yourself. In this case, it's simply been done. Okay?
Does it matter, especially putting equipment before gains on sale? So I think you do it
No.
the other way. But
In the old days, what I would have said is, either way is fine, but if you keep them in the same order as the chart of accounts, you're likely to make an error.
okay,
That was just a practice, but you'll do it on a computer, so it makes absolutely no difference.
okay.
Either
As long
way
as
is
you have
fine.
them on the right spot.
Yep, as long as you're debiting and crediting the right accounts. Debits go first, credits go second, of course.
Right amounts, so like this?
Yeah, the right amounts. What's that?
So like this?
Debits go first, credits go second. You got here, oh, I see what you did here. I'll give you, yeah. Well, here, see if this is helpful. So here's 2, right? Okay, so now there's no gain or loss because the cash received exactly matches the book value, right? Now, am I going too slow here? You guys ready for the third one?
No.
No, all right. I'll put it up in just a minute. Okay? And listen, if you're done on that, what we're going to do next, let's practice some more of this. Do you want to do exercise 1016 on page 424? Do you want to get ahead a little bit? No. Put that up in a minute. So when you're done here, let's do exercise, and it's the same, it's disposal of assets, 1016, and that's page 424. And I'll put the answers up in a minute.